Over the last few months, something has changed in crypto founders' behavior, not in what they say, and what they're quietly optimizing for. On calls, fewer teams are asking, how do we launch a token? And more teams are asking, how do we get users outside of crypto Twitter? How do we build something people pay for before we raise big? How do we pick a category that already has non-stop demand? So in this video, I'm going to give you the 2026 build plan I would follow if I was starting from zero. Step 1. Design distribution path before the product. If I were starting a crypto startup in 2026, the first thing I would not do is design the product. I would design distribution path, because most crypto projects don't fail because the technology is bad. They fail because nobody ever figures out how users are supposed to show up, enter, and repeat. So instead of asking, what are we building? I would ask, where do the first 1,000 users come from? What platform already has their attention? What behavior are they already doing daily? And what is the single action we are replacing or improving? These questions force a realistic, non-delusional strategy from the start. Distribution shapes the product, not the other way around. A lot of teams build features and hope marketing will solve all their problems. That approach doesn't work in 2026. Instead, the real path looks like this: distribution, onboarding, product. Because the way users come in determines what the product has to be. In 2026, attention is expensive, and creators won't explain your product for you, so the product must fit the channel. This is why launches inside Gems, for example, start with structure where we are mapping real distribution paths, designing participation flows around those paths, and activating community leaders and partners who already control attention, tracking which paths actually convert. Once distribution is clear, product decisions stop being debates. Step 2. Don't think you need VC money to start. In 2026, most crypto teams can reach proof faster than ever. Instead of raise, build, hope, the order flips to build, prove, raise to scale. This is one of the biggest mindset shifts crypto founders need to make this year. Let me show you how this works with real example. Rain, a decentralized prediction market protocol, launched early on our Gems launchpad. Not with huge round, not with Wall Street story. The goal was simple: launch clean, activate real users, show participation, and create credible on-chain history. A few months later, something unusual happened, and Livex, a Nasdaq-listed public company, raised $212 million to buy Rain token for its corporate treasury. That's not crypto money, that's public market capital. After that announcement, Rain token reached 27x from the Gems pre-sale price. This wasn't speculation, it was balance sheet decision. Why did this work? Rain didn't raise big to look serious. They took the right approach first: clean launch, real participation, clear structure. What I see in Gems more often is that many startups don't come fully formed. They come early but structured. A clear product direction, a defined distribution path, an initial community or partner base, and a concrete plan to turn attention into action. So instead of raising big upfront, these teams run an early structured phase. They activate community leaders and partners, they test real participation, they generate early usage, volume, and revenue, and they validate that people will actually show up and act. This early phase gives them not just initial capital to build momentum, but real investor signals for future raises. Step 3. Build where demand already exists. If I'm building in 2026, I'm building where money already moves every day. Let's walk through the categories where market demand, revenue, and volume are already validated. 1. Decentralized exchanges and perpetual dexes. Trading volume never stops. By late 2025, decentralized perpetuals were doing tens of billions in daily volume. Execution speed reached near centralized exchanges levels, and liquidity depth improved dramatically. This category is crowded, but still very open. How to enter this market? 1. You don't launch wide. 2. You start with 1 till 3 major assets, 1 margin model, 1 active trader persona. 3. Order book markets reward depth, not asset count. How to stand out? You don't win by marketing alone. You win with predictable latency, transparent liquidations, no hidden priority rules, and verified matching. Traders care only about one thing, not being disadvantaged. 2. Prediction markets. Prediction markets grew total capital to $20 billion in 2025. They proved demand during elections and expanded far beyond politics. How to enter this market? Pick a few verticals: macro, earnings, weather, crypto metrics, sports, or entertainment. How to stand out? Clean user experience design, fast resolution, credible oracles, and markets people actually want to trade. 3. Asset tokenization and real-world assets. RWA grew from $5 billion to $18+ billion in 2025 alone. This is where institutional capital is quietly moving. How to enter this market? Start with one asset class: private credit, short-term treasuries, or real estate cash flow. How to stand out? Credible legal structure, transparent cash flow mechanics, clear redemption logic, boring, predictable returns. 4. Smart wallets and developer infrastructure. This is the picks and shovels layer. As adoption grows, UX matters more, security matters more, obstruction matters more. How to enter this market? Solve one pain point: key management, account recovery, gas obstruction, wallet to app integration, or developer onboarding. How to stand out? Simplicity, reliability, clean documents, fast integration. So the pattern here is simple. Every winning category built on existing behavior: trading, lending, paying, betting, securing assets. If behavior already exists, demand already exists. So your job is not to invent demand, it's to deliver what other competitors are missing and execute better. Step 4. Founder-led distribution is the new trust layer. Founder-led marketing has become more than a growth channel for the past 2 years in crypto space. By 2026, it's a core trust layer, and that trust layer is one of the most powerful marketing channels in the market. Marketing works when everything is smooth. It stops working when timelines slip, markets turn, liquidity drops, or something breaks. And at that point, people don't look at banners or brand account. They look for who is accountable. When something goes wrong, strong founders show immediately. They explain what happened, the impact, and the next steps. This does two things at once. It keeps existing capital calm, and it attracts new capital watching from the outside. Visibility during stress is marketing, whether founders realize it or not. Founder-led distribution is not optional anymore. It's part of crisis management, investor relations, community leadership, and marketing all in one. Let's summarize. If you want to build something strong in 2026 and avoid the mistakes that kill most crypto startups, this is the framework. Design distribution path first, not product. Prove demand and traction before raising big money. Build on the markets where money already moves, and be visible when things break. And if you're building right now and want a second set of eyes before you make expensive mistakes, send me a DM. You will find the links in the description. Build it right and strong for the first time. It's cheaper than fixing it later. See you in the next one.